days, and is it time now to be a buyer rather than a fearful investor about inflation, liquidity, and global crisis? Sunil, good morning. Thank you for joining us. The first half of 2022 was scary, volatile, gut-wrenching, and not a very profitable one. Do you think I'm going to use the same terminology for the second half as well?
Broadly, yes, because the reasons for why the first half was the fear of inflation, the fear of the Russia-Ukraine conflict not ending anytime soon, and at that time there was a fear of a possible rate hike and tapering. The second half, the fears have come true in terms of the inflation, in terms of the rate hikes, and I think that while the second half will not be as bad as the first half. The reason being actually the recession, because what the recession means is easing commodity, easing oil, which is good for Indian economy. So the overall international scenario continues to be uncertain. So FII flows will continue to be volatile and be a negative impact on the market. But domestic news will increasingly get better, and hence overall, I would say while the second half will be also relatively muted in terms of the way markets will perform, I think that it will end on a better note, and you can look forward to a good first half of the next year.
Why is that markets are not excited about this sudden collapse in commodities? I mean, that was the big pain point. High inflation, which is a function of high energy prices, high commodity prices. Crude's in a bear market. Oil prices, palm oil prices are down 50%, copper prices are down 25%. If commodity prices are getting crushed, then why should Indian bulls not be doing cartwheel? A bull like you is sounding cautious to me. With this kind of commodity prices, I was hoping that Sunil would come out and say second half will be higher. It would be triumph of an optimistic. Go and buy. I didn't expect that answer from you.
No, that's because commodities have never been a reason for us to buy or to sell. First of all, we don't like to take too much commodity exposure, but the commodity impact on, let's say, an FMCG or anything, right? See, these are very temporary. The rise in our existence, we found that predicting commodity prices is probably not as worse as predicting currency, but almost there, right? To take an investment call, you can take a speculative call. A trader can take a call, but as an investment call to say that, because of the recession coming in the next few months, commodity price will ease, hence their margins will be better. I'm buying stock from a 3 to 5 year perspective. I want to see what's going to happen to the world at large over a 3 to 5 years and how that will impact our portfolio. These short-term calls on selling off FMCG when the commodity prices rose and then going back, I think it's not a mutual funds play, Nikonj, if I may say. It's a trader's play, it's a speculative guy's play, not from our perspective. For us, see, you talked about being a bull. We've always been bullish on the thing. The point is that it's the FIS selling which is causing the market to be volatile. It's not the Indian players. So you're saying that domestic players going and running, domestic players have been consistently buying. Their buying is not making a difference to the volatility because the quantum of FII flows far outweigh that in terms of the play. And second is, while FPIs are in the large cap space, in the mid and small cap, you see volatility because you need far lesser liquidity flows to impact their prices by the same amount as the large caps. So I would say that you still have to go back and look at why the FPIs, despite the commodities crashing, are not coming back to India. I think that's a more relevant question than domestic investors buying.
Good morning, Sunil. You're fairly vociferous about that. I hope you're as vociferous when it comes to your views on the capex theme, because that's something that we see. It seems to be playing out quite well. It's been a long lull that we've seen, and now on-ground activity seems to be picking up. For instance, we spoke to the management of KEC International as well, who said that there's so much interest that they're seeing across the board for all of their businesses. So, are there any themes or any particular sectors or within this entire capex theme that you'd like to bet on?
See, if you look at the kind of capex which is likely to come to the forefront, apart from the government's drive on infrastructure, is the electricity and power generation. So I think capital goods suppliers to that overall power generation sector, I would say that's where the maximum projects announcement, project execution, commencement has been happening. That's number one in terms of a pick. The second, I would say from a capex perspective, I see is that the auto sector itself, right? We see that with the demand expected to rise and we think that there would be a crunch. There's a shift to EV happening. So there is some amount of capex involved in EV. So the auto sector end user, those cap goods suppliers which are going to cater to that would be my second pick within the overall cap goods space.
Okay, fair enough. That's a view coming in on the capital goods. Interestingly, yesterday in a conversation with Temasek, they were talking about digitalization of financial services emerging as a strong theme and just digitalization playing out across the board. Given that we're also addicted to our phones, our laptops, etc., you can see why there's a case for that, Sunil. So any themes within this space or some of the recently listed companies, the likes of Paytm, Policy Bazaar, what's your view?
See, overall, we're very positive on the digitization and the formalization of the economy. And we think that the resource crunch is also coming through. Salaries are going through the roof on the IT and the related digital sector. So we think that that growth, right, essentially is going to have a spin-off effect on the overall consumer surplus and the consumption story. That's one. But more importantly, I think the penetration of mobiles within rural India, the real Bharat, as say, I think is going to lead to a huge data with 5G auctions also coming in. The ease with which people will access data, use data is going to phenomenally go up. And whether it's in the lending side, whether it's in the data usage, entertainment, everywhere. So we see this as a wide-ranging play. In fact, we have a dedicated fund called the Services Fund, which has a significant allocation to the digital fintech and all of those plays. So we are keenly looking at that space from our portfolio allocation perspective.
Good morning. Sunil Sinetara also that's joining in. I'm going through, the recent tweaking to your portfolios, the recent purchases, as well as the recent sell-offs. And what I've noticed very interestingly is in your recent sell, you've got HDFC Bank as well as ICICI Bank. I know question banks was also asked, but everyone is now thinking that this is the year that maybe IT is not going to perform and banks are going to do what we historically think IT will do. Are you taking a different view?
No, we had the same view till a few weeks ago. But what's happened is that since a large part of the market is playing that view, the banking valuations have gone up and the IT valuations have corrected, right? Because everybody is betting on these. So now it's not like IT are bad companies or banks, so the reallocation of the portfolios, right? You mentioned, Sel, I can't talk stock specific, but what's happening is if large IT companies are now correction in a way that the value now looks reasonable. We always look for growth at reasonable prices. IT had run up huge in the post-COVID phase because from a safety-oriented play, it had shifted into a growth story and super growth story. Now the super growth has got tamed down and that's why the correction happened. But when the correction goes beyond a certain point, then there's a value buy there in the larger IT space because two things are still in their favor, right? Even in a recession, there will be some amount of IT spend because people want to reduce costs, right? So they will rejig their portfolios on IT. That's number one. Second is what we are talking about in a rate hike is a strengthening dollar. Now, initially, that dollar strengthening, rupee weakening story, which is favorable to IT, did not play out in the stock play because the overwhelming feeling that they are overlong on IT. But now, as you see the valuations correcting, a weakening rupee story is actually positive IT. So both a combination of the price correction and the story of a rupee weakening are turned mildly positive for the IT sector. And so good quality IT companies which have corrected reasonably are naturally something we'd like to add on. At the same time, on the banking space, we remain bullish on banking and financial services. But since everybody is now kind of joined the bandwagon to say, FIIs sold banking because they were selling India, right? But in the future, right, banking is essentially domestically linked. So as the domestic economic growth story plays out, banks will benefit. So here was a correction which was not linked to any international issues purely because of selling, but there's a strong footprint. So banks are obviously a buy across a lot of counters. Naturally, those have taken valuations up. And as a portfolio, we always have to look at, am I getting that growth at a reasonable price? So reaching of portfolio will happen all the time based on these views. But fundamentally, otherwise, we remain positive on the banking and financial services space. I must reiterate that.
Okay, we'll check out for your next update. And if you've accumulated a lot of on those IT stocks, the likes of TCS, HCL Tech, Emphasis, Birlasoft, they've all hit a 52-week low. Even a stock like Tata Lexi, 9,000 rupees, now trending towards 7,000. So we'll wait for the next update because you said you're not going to be stock specific. But what I also noticed is, Sunil Subramaniam, is that Maruti Suzuki, Eicher Motors that you have bought, we've been talking about the leadership coming to the auto stocks, 10% weightage of the index, but that's another thing that everyone is betting on, and there you're going with everybody else.
So there, the reason is that it's a cyclical sector, right? In a cyclical sector, you have always a V shape, right? And what happens is that because of the linearity of people's thinking, of analysts' thinking, right? When something goes from, let's say, 12 to 10 to 8, they predict 6. And when something goes from 8 to 10 to 12, they predict 14. But actually, the V takes 12 to almost 20 because that's the cyclicality. Now, the cyclicality in the case of auto got enhanced by a downturn during the COVID for demand, a downturn led by semiconductor shortages on the supply side, and a commodity price hike, meaning their input costs on steel, on paint, everything went up. So the auto stocks got hammered a big deal in that. Now, what's the story playing out? We have commodity softening. We have interest rates continuing to be reasonable for the EMIs to be, affordable, and we have a pent-up demand. As you can see from all the private vehicles, tractors, everywhere the pent-up demand is coming through. Now, in a high leverage play, right, where the operating leverage is high, your 10% growth in the top line can be a 30 to 40% growth in the bottom line. Now, that's where when now buying is happening, right, the actual EPS numbers when they come out, I feel will beat the consensus estimate. And so at this point in time, we believe that being overweight on autos is a sensible thing because there are a lot of positives turning the way of the auto, including the cyclicals in terms of commercial vehicles also coming into play. So at this point in time, we continue to remain bullish there. And you're right that the market is also thinking the same way. So everybody is buying.
Up start in IT, but it comes crumbling down again. Bear in mind that even at 52-week low, there is just no respite for some of the IT stocks. Commodity goes down, well, in the short term, it will create a upside in some of the FMCG stocks. So there's HUL, Britannia, Nestle, Asian Paints, Tata Consumer, Pidilite, even Marico. That's the easy trade, and that's the like a obvious trade, which is now getting more and more pronounced. Sell-off in commodities, bad news for metals. Tata Steel is down, Vedanta is down, JSW is down, and Hindalco is down. So it's like a complete mirror image of, let's say, what we've seen in the first half of this year. Commodity stocks or commodity prices are in a bear market. I like the ring of that. When oil is in a bear market, that's the only bear market I like. Sunil, this is the only bear market we like, right?
Absolutely. Being in India, you have no choice. You got to keep praying for oil to go as low as possible. $40, $20, the more the merrier. That's absolutely, because it has a double impact. So one is in terms of corporate margins, second in terms of the currency and the fiscal deficit and the trade deficit. So both as an economy and as corporate India, right, bearish oil is extremely positive and bullish, right? The key thing is that, of course, is that FPI still have not converted that bear market outlook into a India positive, flow positive outlook. When that happens, you'll see a dramatic shift happening.
So Sunil, we don't know when our fair weather friends will come back. I hope they come back. I hope this is a small patch of just bad rain like Mumbai rain. When it pours, you pray, but you know that eventually it will get over. Or it's like Chennai water problem will only come periodically 3-4 times in a year. So I really hope it is like that. But what is more permanent, I guess, is the fact that Indian investors are coming back. There's some data which we've looked at, which is that if one looks at the total kitty which is available with mutual funds, with NPS, with pension funds, the number stands at about 3 lakh crore. So despite FII selling, can one be reasonably sure that there is enough and more ammunition left still there with the domestic institutional investors? So even if FII sell, the market's back would not be broken?
I agree with you there, that there is enough domestic confidence in the Indian economic growth, in the political dispensation taking reforms forward, that and the fact that from a perspective of buying, the only counter to what you say is the fact that domestic investors buy broad market, FIs sell large cap oriented market. So there will be a disconnect there, and in terms of that, and that spillover happens, into the small and mid caps. So while domestic buying will continue, the back of the market will not be broken, will be strongly supported by them. Strong rises will have to depend on our fair weather friends, as you call them, to come back into the market. So their buying power and their thing is obviously it's a lumpy, big ticket buys, right? Whereas mutual funds are getting very good SIP flows. They're by steadily accumulating stuff that they believe will create value. But FIS come in and move the needle, right? So while the back will not be broken, the volatility will be there until FIS turn positive on our Indian markets.
Okay, Sunil Subramaniam, we're going to leave it at that. It's always a pleasure talking to you. Thanks so much for joining us live on this Friday's